Thank you, Kat. Thank you, everybody, for dialing in today for our quarterly market webcast. For those of you that are on the phone and can't see the slide presentation that we're going over today, you can always call or email into the office for a copy of those slides. And there will also be a replay of today's webcast that will have the slides posted on the website. Excuse me. Okay, so today we're going to get into the markets a little bit more. We're going to touch upon the themes that we wrote about in our most recent market monitor, and hopefully explain those in a little bit greater detail, and then also answer questions at the end. Okay? So we're going to start with the U.S. economy. I've given it this moniker, which is Supertanker America, and that is actually a nod to the term that was coined by Abby Joseph Cohen. She was, for those of you who remember, the chief economic strategist at Goldman Sachs back in the 90s. And she used to refer to the U.S. economy as Supertanker America because if you think about a large tanker, right, the thing about it is that once it gets going in its intended direction, it usually carries pretty good momentum with it, and it's not that easy to get it to turn around and change course. And so that's kind of how we think the economy is going right now, that it's really been starting to click on all cylinders and gaining momentum, and things don't really turn around that easily when you get to that stage. Okay? So let's start some of the factors that are supporting the economy here. The first thing that we're going to talk about is the recent reduction in the corporate income tax rate. Okay? So what you see is that the recent corporate income tax has taken the statutory rate from 35% all the way down to 21%. And that's actually the lowest corporate tax rate that we've had here in the U.S. since 1939. Okay? So while some people might want to discuss, what that means for the deficit and that sort of thing, I'm not saying that that's not a valid discussion, but for today's purposes, we're going to focus solely on the viewpoint of the investor. Okay, and from that perspective, these corporate tax cuts are stock market friendly, to put it bluntly, right? Because think about it this way: if you reduce the tax rate for any given company, you're going to provide an immediate boost to the underlying earnings per share. And all else being equal, if you boost earnings per share, you're going to get a boost in the stock price as well. Okay, so the tax cuts, we've already started to see as they've been priced into the market here. It's one of the things that helped boost stocks so much in January. We think we're going to continue to see more of that as managements kind of spell out and put pen to paper and talk about just how big the impact is going to be of the tax cut and how much it's going to increase cash flows and things like that. The other part of it is to the extent that these tax cuts boost incomes for a lot of households, right? If you are a small business owner who has an LLC or a pass-through entity, the tax rate is going to benefit those people as well. So the boost in income to these households should also create a boost in consumer spending, which, consumer spending being the biggest component of the economy and the GDP calculations should help to boost GDP as well. The next slide that I wanted to point out, this is a weekly leading index that's put out by a group called the ECRI, the Economic Council for Research. And this is a research group that does really good work, and this is a pretty long chart here going all the way back to 1965. But what I thought was interesting about this chart is what you can see is that every time that the chart breaks out to a new all-time high, it usually runs for several years before it tops out again. So if we look all the way to the right-hand side to the most recent readings, we see that just last year, this index broke out to a new all-time high. And so that kind of lends itself to the notion that this strength should continue for a while and that the economy should have, additional room to run. Okay? This next slide is of an index that we also follow. This is called the Citigroup puts this out, and this is an economic surprise index. And what that means is that it tracks various economic indicators and how that economic data is coming in relative to expectations, right, relative to the consensus figures that are out there. So when incoming economic reports come in better than expected, when they top expectations, that's what makes this line go up. And so what we can see is since mid last year, since the summer basically, we had a turn in this index where data started coming in stronger than expected. And so that's where you can see that we've had a really sharp rise in this index. You know, and some of the things that we mentioned in our most recent market monitor were just how many of the economic data points that we follow have been coming in and making multi-year highs. I mean, just today, the index, the ISM index for the services sector, which is the biggest component to our economy, printed its highest reading since August of 2005. So we're getting a lot of strength in the economic readings, and it should have legs to it. Okay, this next chart, this is a chart that's put out by the Atlanta Fed. So the Federal Reserve has 12 different districts. The district in the southeast is the Atlanta Fed, and they put out a monthly forecast for what they think GDP is going to come in, you know, what economic growth is going to look like. And the surprising thing about this chart is that you can see up here at the top that their most recent projection is for Q1 GDP to come in at 5.4%. So it's been a really long time since we've seen a 5% reading on a GDP report. I think that the last time was in 2003. And the reason why I say if is that this current forecast is based on all the economic data that has come in so far in January. So it still will be subject to revisions for data that comes in February and March. But even if it comes in anywhere close to this 5.4%, it would still be a really, really strong reading. And it just kind of falls in line with all the other sides that we've talked about so far. Okay? So now I also want to talk about the Federal Reserve and where the Fed stands in terms of this current rate hike cycle, right? How many times has the Fed raised interest rates relative to past cycles as well? So you see that on this chart here, if we look at the last cycle, back into 2004 all the way into 2007, the Federal Reserve hiked rates for at meeting after meeting for many years in a row, and they hiked the Fed funds rate all the way up to 5.25%. Then we know in the aftermath of the recession of 2008, they had to cut interest rates and bring them all the way down to zero. And the surprising thing is that they held rates at this zero level for a little over 7 years, right? So it was a really, really long time to have monetary policy at such low levels and being that accommodative, we call it, right? So we also know that they did these quantitative easings. They did QE1 and QE2, and they had all of these things that they were trying to do to get the economy going. So, people sometimes ask now, is this current expansion getting long in the tooth, right? That it's been going on since 2009. Is it getting too old, and is it time for things to roll over again? And we would argue a couple things. The first thing is that considering the outsized response that the Fed had to the last recession, how low they took interest rates and how accommodative they've been with monetary policy, that outsized response on the part of the Fed, we think it's normal to expect there to also be, an elongated upcycle in response to what the Fed has done. The other part of it is that, when people say is the expansion getting long in the tooth, economic expansions don't usually die simply from old age. They usually die when the Fed has to take interest rates so high that they choke off growth. That's what happened in the late 90s. That's what happened again in the mid-2000s. The Fed continued to raise rates because they were worried about inflation and the economy getting overheated, and eventually that caused things to roll over. So on the right side of the chart here, you can see that currently the Fed has only taken the Fed funds rate up to 1.4%. So it still is a very low level. Right now, the current projections out of the Federal Reserve is that they're expecting there to be another 3 rate hikes this year of about 1/4 point each. That would take this Fed funds rate to about, let's call it 2.1, 2.2%, which is still pretty low by historical standards. So again, there still is time, for this cycle to run before the Fed takes rates so high that it would start to choke off growth, that sort of thing. Okay. This is a chart that's put out by a group called ISI Group, and what they were looking at here was they track a number of indicators to try to gauge the probability or the likelihood of a recession in the next 12 months. And what you can see here is that currently this model of theirs is forecasting only an 18% chance of recession in the next 12 months. Okay, and so then the important part, the takeaway from that is, well, given that when you have a model like this that's forecasting just an 18% chance of recession, what does that mean for the stock market? And so what they then did was they looked at how that model of theirs translated into stock market performance over the next year. And what you see here is going back all the way to 1945, when you've had the probability of recession this low, 87% of the time you've had a positive return in stocks over the next 12 months. And only 4% of the time have you had a decline of at least 10%. So it's pretty strong data or indicator that's pointing to a conducive backdrop to have a good year in the market this year for stocks. And again, this is with over 70 years of data, so it's pretty strong research point. Okay, so that's a little bit on the economy. Now we're going to turn to the fixed income or the bond market. And here what we're talking about is we're going to say that tailwinds become headwinds. And I'll get into a little bit more about what exactly that means. This is a chart right here of the 10-year Treasury yield of the government bond. One thing that I do want to clarify is that when we talk about the Fed, the Federal Reserve raising interest rates, the Fed is only able to control interest rates to raise or lower rates on the very, very short end. So the Fed funds rate that they're in charge of, that's actually an overnight rate. It's a very short-term interest rate. The longer dated interest rates are controlled by the market, right? And so in this case, what people consider the benchmark 10-year Treasury yield, this is set in the market, okay? So what we see here is that in recent years, bond yields have mostly been going down. But last year, or actually in 2016, after the election, we saw this sharp spike higher in bond yields, okay? So bond yields ran up in the aftermath of the election, and they got all the way up to this 2.6% level before they kind of ran into resistance and topped out. And from there, they pulled back, for a couple months, and in the spring of 2017, they came back to test that 2.6 level again, and from there backed off again. And it wasn't until early this year, in 2018, with economic growth strengthening again, that bond yields were able to get above that 2.6 level and break through it. Okay, so if we back out this chart a little bit further and look a little bit further back in history, we see that the last time that there was a similar spike higher in bond yields was back in 2013. Okay, and what was going on in 2013 was we had this little episode that the bond market called the taper tantrum, and that was when the Federal Reserve made a comment that they were going to be looking to quote-unquote taper some of their bond purchases or their asset purchases that they were making in the open market. So that caused a sell-off in bonds, which pushed yields higher. Back then, yields ran all the way up to the 3% level. Again, they backed off from there. A couple months later, they came back and tested that 3% level, but that was the high. We haven't been back to that 3% level since then, since early 2014. So you've seen bond yields kind of trade down and sideways for a long time. Now they're just starting to move higher again. We think that if economic growth remains strong the way that it has been, that it's likely that the 10-year yield will work its way back towards this 3% level, but it's unlikely that yields are going to just shoot right through there on their first time, right? As we've shown in the last chart and this chart, oftentimes when you reach a major level like that, it does act as some resistance, and it takes a couple tries to get through it. So it's possible that the 3% level, it's likely that it'll be a lid the first time we get up there, and it's possible that it could be the lid for the remainder of the year. Maybe we get a little bit higher than that. Okay. This chart, when we talk about, I mentioned about tailwinds becoming headwinds, this is actually a much longer chart going back 50 years, looking at the 10-year Treasury Index. And you can see that all the way back, going back to the 80s when bond yields were much higher, we've pretty much had a 30-plus year where bond yields have been moving lower for the most part. Okay? But since about 2011, when bond yields made this low right here that I'm pointing to on the chart, yields haven't really moved lower since there. So we made a low in 2011, bond yields bounced from there, and then around 2015, 2016, we came back down and tested those levels. So for the most part, we don't see bond yields making new lows, and we think that, you know, this long 30-plus year chart where we've had yields moving down, that's really been a tailwind for bond investors, because not only have they enjoyed the coupon or the interest rate that they've received on their bonds, but as bond yields move lower, bond investors also get some appreciation in the underlying price of those bonds. And so we think that that's going to be harder to come by going forward, that it's more likely that we're going to see bond yields working in their way higher as opposed to continuing to move lower the way that they have for, you know, the past few decades. Okay, but when we talk about higher rates, you know, while mostly bond investors, you know, think about the negatives of higher rates, we also need to take into consideration that higher rates can be a positive too. And what this chart is showing is that since 2008, there has been a huge demand and a huge amount of cash that has piled in to what are called demand deposits. And demand deposits are basically your everyday checking and saving accounts at banks, right? So cash balances at these checking and saving accounts has just ballooned in recent years. And the way to think about it is, as the Fed continues to raise interest rates, all of those savers are going to start collecting more in terms of interest payments, right? So household interest should continue to go higher to the extent that, you know, that increase in household interest will get spent. You know, it's another thing that could provide a boost to consumer spending and help support the economy. So there is kind of, you know, two sides to the higher rates coin. Okay. And with that, let's move on to the stock market. And the title for this portion is Enthusiasm Finally Surfaces. And this title was actually written before the last few days of volatility in the market, but I still think that it's applicable, and let's get into some of the reasons why we think that. Okay. This chart here, this is a chart basically of the investor psychology pendulum that characterizes most bull and bear markets, right? So you see a bull market continues to go up till it reaches the euphoria stage, and it comes down for a while, and eventually at the bottom of a bear market, it ends with what they call the despair phase. What's interesting is that in recent years, this bull market hasn't really moved into the optimism phase. It's really been vacillating back and forth between kind of panic and relief, right? So every time there is some news that comes out, you know, some negative headlines, you know, whether it was Brexit or worries over the election, geopolitical things, you know, investors very quickly have kind of moved back to this panic phase, and then once the news subsides, they've moved back into the relief sort of thing. But it's only just recently, I would say probably late last year and more so into January, that we've started to see investors climb more into this optimism, you know, this optimism area of the market phase, and maybe a little bit into enthusiasm. But this is a normal course of action for bull markets. Usually, as bull markets wear on, people do get more enthusiastic about the gains. You know, more money does come into the market, and that helps drive things higher. So we would expect that after this correction runs its course, we think at some point the market will go on to make new highs this year, and that should continue to feed into this positive feedback loop where investors do get more optimistic and enthusiastic about the market, the stock market, that is. Okay? That also brings us to this slide where I wanted to talk about fund flows. And fund flows is the amount of new money that's coming in off the sidelines into the market. So the part of this chart that I really want to focus on is this yellow line. And what the yellow line is showing is the cumulative amount of money in both mutual funds and ETFs that's coming into or out of the market. And what's interesting here is that even though you see this line going up at times, for the better part of the last 10 years, you see that the line is lower than where it started. So really there's been, on a net basis, no new money has come into this market in the last 10 years. And if we think about that in terms of just traditional supply and demand, what's interesting is that the supply of stocks has been going down over the last 10 years. So, and that's related to a few different phenomena that have been going on. One is obviously corporate buybacks. As corporations continue to buy back stock, that lowers the supply of stock. There's also been a lot of M&A. So every time that there's mergers and acquisitions, you know, there's fewer publicly traded stocks in the market. And so one of the areas that this can be seen very clearly is there's an index which is meant to be a really, really broad index of the entire stock market. It's called the Wilshire 5000. And when it was created in the 70s with 5,000 stocks. In the late 90s, when there was a ton of IPOs and new stocks coming out, I think that the index topped out. It had about 7,000 names in it. Since then, it's continued to dwindle. And at the end of 2017, the Wilshire 5000 only contains 3,500 publicly traded stocks in it. So if we do get into a situation where there is increasing demand for stocks, right, if there's new money that starts coming into the market, if investors start, you know, adding money to funds and pulling some of that money that's been sitting in cash and bringing it off the sidelines, that should continue to support stocks and drive stocks higher because you'll have a situation where the demand likely exceeds the existing supply. The other thing that we haven't really gotten into but will also be a big positive is there's going to be hundreds of billions of dollars coming back from corporations in terms of repatriation. You know, all of this money that's been sitting abroad that's going to get repatriated. And while the corporations probably want to sound politically correct and say that they're going to use it to create jobs and invest in infrastructure in America, you know, we know from recent history that probably a big chunk of that is going to be used for corporate buybacks. So it's just another thing that should be stock market friendly. Okay? The next slide shows how the stock market has been doing or how well it correlates with the underlying earnings. So the red line here is the chart of the S&P 500, and the dotted line beneath it is a chart of the earnings per share, the underlying corporate profits behind the S&P 500. So, you know, one question that we get is, you know, was the big rise in the market last year justified? And when you look at it, you know, the S&P on a price basis was up about 19% last year, but the underlying earnings growth was 18%. So we would say that, yeah, you know, most of last year's rise in the stock market was actually fundamentally supported by the underlying earnings growth. You know, if the earnings weren't growing, if this dotted line had stayed flat while the market continued higher, you know, that would have been a little bit more cause for concern. But, you know, we've seen earnings estimates just continue to ratchet higher, and that's one of the things that's been supporting stocks. Even in January, if you look at the far right-hand side of this chart, even in January when stocks really started accelerating and moving higher, you know, one of the reasons was because as the tax cuts started to get priced in, we also saw a very steep move in the estimates for 2018 earnings per share. Okay? So again, the tax cuts, the strength of the economy, all of these things have been factored in here, but it does support the notion that the move in the stock market recently has been supported by the underlying fundamentals, not just speculation. Another question we get is that coming into the year, stocks were trading at about 18 times earnings when you talk about the price earnings multiple on the market. And so people say, well, isn't that, you know, getting a little high in terms of historical valuations? Isn't that a cause for concern? So what this study took a look at is if you look at any given level of PE, how good a job does that do in forecasting returns in the market 1 year later? Okay, and so the data on here goes all the way back to 1958. And what it shows is that looking at PEs alone isn't a very good predictor of what stocks will do over the next year. When they ran the correlation on this study, you see that the correlation actually was negative, meaning that, you know, trying to use PEs as a tool or as a gauge to tell you what you should do or if you should stay invested for the next year just isn't a good strategy. So there's a lot of other factors that do a better job that need to be taken into account, and those are the things that we always try to keep up on and keep track of and write about in our quarterly market monitors. This next chart gets into volatility a little bit, right? And so actually the title of our last market monitor was, should investors brace for more volatility? And as we went through, you know, our letter, our response was yes, that what we were trying to say was that 2017 was an uncharacteristically low year for market volatility, and that investors should be prepared for more volatility ahead. Obviously, with the market action over the last few days, we've seen that come through in spades, but this is kind of, a graphical representation about, why that was the case. And so if you look on the far right-hand side of this chart, you can see that in 2017, the largest pullback we had in the market from top to bottom was 3%, okay? And this chart actually goes back 37 years. And you can see that in the last 37 years, there was only one other occurrence back in 1995 where we had such a shallow intra-year pullback. And what you can see is that in the years following a year like that, you've seen volatility pick up. So most of the years that are on this chart, you see on average that stocks have about a 10% pullback in most years. So it had been a couple years since we've seen a pullback of that nature, which just made it more likely that one was going to come sooner rather than later. The market was just kind of overdue for a pickup in volatility. Taking it a little bit further, this next chart, this is a chart of an index that tracks volatility in the market. It's called the Volatility Index, or the VIX. And you can see on the far right-hand side of this chart, late last year, the VIX actually made an all-time low. So we were seeing record low volatility in the market. And the thing to note from there is that usually when you get, such low volatility, it can lull investors in a sort of sense of complacency, and then ultimately that complacency ends when something happens to cause everybody to wake up at the same time, and all of a sudden you get a big spike in volatility out of nowhere. And that's really what we saw start last Friday and carry over into Monday and a little bit today. So this chart is a more current chart of the volatility index, and you can see that starting last week there was this big spike higher. This chart actually ends last Friday. If we added yesterday and today to it, you would see it even move higher. But from a contrarian standpoint, the fact that you saw this big spike in volatility and a big spike in fear, it's actually a good sign to help the market kind of put in a bottom. So when you have a lot of selling, you want to see some panic. You want to see some fear in the market, and that's usually a sign that the selling pressure has kind of exhausted itself. And I think that's what we saw a little bit of this morning when the market opened down and the volatility index spiked higher, and then we saw the market find its footing, and ultimately, the Dow rallied hundreds and hundreds of points to today it closed up 567 points higher, so probably a sign of a little short-term bottom there. And this last slide is just another graphical picture. This is the S&P 500. And it just shows how it had been trading last year in this fairly quiet but upward fashion. And it wasn't until you got into 2018 that we see the market really started to, the increase in the rally really started to steepen and get a little bit overdone. At the top of this chart, this is what's called the Relative Strength Index. And you can see that it really got into what we call overbought territory above the 70 level. And it's kind of like, stretching a rubber band. You can continue to pull on it, but it only goes so far until eventually you're going to get that snapback. And so that's what we've seen in the last few days. But the thing to remember is that in bull markets, as long as earnings are still increasing and the economy is still sound, pullbacks are usually buying opportunities. So we don't want to forget that. We don't want, the recent volatility to be a reason, to get shaken out of our positions. So in summary, again, we want to be focusing on the fundamentals. That's going to help us as investors to make rational decisions over just emotional ones. We went over how the economy is showing good strength. Think about that supertanker America analogy. There is a low probability of recession in the near term. We think that bond returns are likely to lag due to the interest rate headwinds that we talked about. The stock market is really enjoying a Goldilocks-like backdrop, right? We talked about strong earnings growth, the tax cuts, low inflation, the repatriation and buybacks that are coming. So in all, we really think that all of this lends itself to the notion that it's just too soon to start talking about getting defensive with respect to our asset allocations. We still think that this bull market has some gas left in the tank. And with that, I will leave it on a lighter anecdote. And there is a market strategist whose work I enjoy reading. His name is Jeff Sout, and he writes for Raymond James. And last week, Jeff was talking about this bull market and the volatility, and he brought up the movie Secretariat, which you'll remember was the racehorse who won the Triple Crown back in 1973. And in the final scene of the movie Secretariat, Secretariat's running in the Belmont Stakes, and he's pulling ahead from the pack. He's way ahead of the pack, about 30 lengths in the lead. And the only thing that his trainer can think of at the time is the trainer screams to the jockey, "Don't fall off." And that's kind of how Jeff was saying investors need to think about this market, right? That just don't fall off. So with that, I will turn it back over to the operator and for a Q&A session.
Thank you so much. The floor is now open for questions. If you do have a question, you may press *1 on your telephone keypad, or you may type in the chat. And we do have a question on the chat. Would you like me to read that, Jordan?
Sure.
Hey, thanks for the webinar. I was wondering if you could comment on the U.S. dollar currency index going down since January 2017.
Yeah, the currencies are very difficult to kind of predict in the short term. It's why we don't usually make prognostications on them. I mean, all else being equal, you would expect that if the Fed is raising rates and the economy is strengthening, that should provide some underlying strength to the dollar. But what you can also have over short-term periods is that the dollar doesn't go up and down in a vacuum. It's always relative to other currencies, right? And so I think that there had been a little bit more pessimism to the euro and the yen. And so as those economies have also started to strengthen, I think there's been a lot of demand in the foreign exchange market that has gone more towards those currencies. So the bounces that you've seen in the euro and the yen had to come at the expense of something, and so I think it was the dollar that's just kind of fallen by the wayside. But I don't really think that it is sort of an indicator of a weakening economy going forward. And actually, for the stock market, in the short term, it can be a net positive because all of the multinationals that have more than 50% of their revenues coming from abroad, a lower dollar will actually translate into higher earnings. So we should hear some positive comments from managements when they discuss that part of it.
And there is another question on the web. How far will the market have to drop to start getting defensive as well as seeing buying opportunities?
So, I already think that we've seen buying opportunities. Anytime you start getting, a 5 to 10% pullback in a bull market, you probably can start looking for those buying opportunities. There's no magic number in terms of how far the market needs to drop. Usually what happens in corrections like this is you have this initial kind of wave down in the market. Then you get some sort of bounce, a kind of a relief bounce. And then at some point you have a retest of the levels that the market bottomed at the first time. And that retest is often actually the best time to really look for opportunities.
And the next question is, we have quite a few bonds in our portfolios. Do you think this might be a good time to shift some of that bond money into stocks?
So that's a little bit difficult of a question to answer, only in the sense that it's really different for every individual investor, right? So I don't know if the bonds that you have in your portfolio are there because you need to generate a certain amount of income that you're taking from your portfolio every year. But if it was just the fact that in recent years bonds have been doing well relative to stocks, and you really have kind of no bias one way or the other, I do think that stocks are going to outperform this year, and so the average balanced portfolio probably should be a little more tilted towards stocks than bonds if that fits within, your individual risk tolerances and parameters.
And that appears to be the last question at this time.
Okay. And didn't have any questions from the phone callers?
No, we did not.
Okay, great. I think we have one more coming in.
Yes. What I've been reading is that the volatility we are currently experiencing has to do with a rise in earnings, wages, and uncertainty about Fed rate hikes going forward. Could you comment on current inflationary pressures? What factors are currently influencing this?
Okay, so first, in terms of the recent volatility having to do with a rise in earnings, I really don't think that's the case. I was watching this whole correction unfold in real time, and there really was no fundamental catalyst for it. It was just kind of the market had gotten overbought, and I think that a lot of investors were kind of, trying to stay invested, but with one foot out the door, thinking that if we did get a correction, they would do some selling. But as we know, everybody can't fit out the door at the same time. And so I think that once the selling started, it just became very crowded. We know that in recent years there's computer algorithms and things that also probably exacerbated the selling. So I really think that the sell-off was more a function of just how high the market had gone in such a short time and how long it had been since we'd had any sort of correction. In terms of uncertainty about the Fed rate hikes going forward, I don't think there's that much uncertainty. The Fed commented about some of the recent inflationary pressures, but on a daily basis, there is a market or an indicator called the Fed Funds Futures. And this future market, in a real-time basis, tracks the probability for Fed rate hikes. So it had been pricing in between 3 and 4 rate hikes for this year. With the recent volatility we've seen in the market, we saw that those Fed Fund futures come off a little bit. So now they're pricing in maybe a little less than 3 rate hikes this year. But a lot of that is just going to depend on, as you said, current inflationary readings. And those things, the factors that are influencing that are, the CPI, the different indicators that the Fed monitors to gauge inflation. We've seen oil prices move higher, and so some of that may be factoring into it. But for the most part, the Fed's goal has been to try to get inflation back to 2%, right? Because the Fed, what they really want to avoid is the economy getting into deflation. So a little bit of inflation the Fed is okay with. They think that they can deal with that by raising interest rates. But it's been a while since these indicators have even reached that 2% level that the Fed is looking for. So I think this year it's more likely that we're on track to see that.
And we still have no phone questions.
Okay. Well, that's great. Well, if that's all the questions that there are for today, you can always call or email in with any other questions that you think of, and we just want to thank everybody for attending today.